Do you think that we will see that $30 level breach this year, and what would it take for that to happen? Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics as we dig back into our coverage of the silver world. And fortunate to have John Lee of Silver Elephant Mining back on the show today, as John, a student of the silver market, has had some interesting market calls on the silver pricing over the years, looks at a lot of the technicals, and been a while since we caught up with you, John, but excited to have you back on here and talk about all the goings on in the silver market. Certainly plenty happening, and good to see you again. And how are you doing today, my friend?
Well, good day, Chris. Good to be back on your show. Good to see you again. It's been about a year sabbatical. As the market last year was quite challenging in 2022. It does look like we're actually in the clear for the silver market to take off the year 2023. It's in a way, it's almost a complete 180. Silver went from the low of 1650, actually called a bottom in another show last October, and now it's gone up close to 40% from the low. So I'm not surprised to see a little bit of consolidation retracement here. However, if gold were to stay above 2000, it looks like increasingly so to be the case, then I don't believe it's going to take long before silver take a challenging $28 magic handle again. And this time, assuming that gold stays over 2000, then the silver is going to take out $28 sooner or later this year.
Yeah, and interesting as you mentioned, because here we are back in October of last year, down at 18 bucks. Actually went slightly below 18 at one point, and then as we're recording on Wednesday, May 10th, we had a CPI report out that came a touch below expected. And interesting, we had silver spike up, now getting punished a little bit on the day. So still slightly under $26. Um, but I guess let's start there. You mentioned that you see 28 in our near future, and I know you said in some of your other interviews that I've caught recently that you think this will be the year that we break 30. What do you think that it will take to get above that 30 level? Obviously, we have the Fed still hiking rates. Some people expecting that they will cut later this year. I know you're of the school of thought that that might not happen, but do you think that we will see that $30 level breach this year, and what would it take for that to happen?
Yes, I do, Chris. It's not so much in terms of the fundamentals per se, because the fundamentals for silver today is the same as it was 6 months ago, which is the same as it was back 3 years ago when silver went close to 30. So what is really going to drive silver in this year, and that's what the reason I believe is going to take out 30 is more to do with the technical indicators. The prices are heavily managed. The price discovery process being long gone. Silver typically is sort of taking the guidance from gold. So if we were to look at gold is where gold is headed, is try out that $2,000 level 3 times this year since 2000, the last 3 years. And this time it does look like it has a stronger sort of a push to make it past 2000. And fundamental wise, I mean, you cannot get even a more picture perfect scenario, right? You have a war going on in Ukraine that hasn't ended, even though there's not a lot more news coverage than was before. Thousands of people are still dying. Weapons are getting shipped to that country. And secondly, I think more important or more sort of the principal driver for this big push beyond 2000 and $30 silver and 2000 for gold is the breakdown of the dollar as the world reserve currency. You used to be the dollar and the United States the safe haven for everybody. I mean, Chris, you watched the movie The Hunt of the Red October, or everybody is sort of, so the ultimate dream is to settle down in a ranch in somewhere in Montana and then be well off, and you have the Gorbachev that flew to DC, and also the Gandhi Sanchez from the Bolivias, and it just seemed like it used to be the case when that dollar and that United States was the safe haven, was the refuge. However, as you know, there's just a lot of brown nosing of the U.S. into other people's business, cutting off SWIFTs. They took 350 billion from Russia and put China on notice, and they're now the friendliest terms with Saudi Arabia, and collectively looking at more than $2 trillion of reserve that are not seeing eye to eye with the current administration. This is really very similar to the deja vu to back in the 1970s when Charles de Gaulle called the bluff of the $35 peg to an ounce of gold, and then took that dollar to the U.S. Fed and the Treasury and say, "I want my gold," and that's why really break the gold window in 1971, 1972, and that precipitated a big run up from $30 to $800. Chris, I just want to share sort of my thoughts there. Is the peg was there for decades, and finally when the peg broke, then gold went from 30 to 800. So it's not just the doing of the 70s; it's actually going back to the 50s and 60s when they were printing, but without people noticing it. Right. So what we have, Chris, is if you look at sort of the dollar from 30 to 800, it's a 25x in the 70s. It's kind of very similar to what we saw from year 2000 to where we will be maybe 3 to 5 years from now. Even though there's no such a peg per se, but the peg is implicit through the very deliberate and careful management of the gold price. So therefore, if you say the Gordon Brown's $250 as the starting point for the run up, like it was back in the 70s, so if you to multiply 25 by say 200, 250, you will come at a gold price of around 5,000, which, Chris, I believe probably should be where we are right now at 5,000. And the reason is not you have all the cryptos and you have the JP Morgans managing through the futures and the ETFs and the GATA and other people had documented this extensively, I mean, with all the current events happening, you should be having a $30, $50 gold swings on a daily basis, like the cryptos were back in the days. But yeah, we're not. And silver, you should be moving, $2 to $3 on a daily basis, which we are not. And the reason is we're trading something around 250 million ounces of silver paper per day on the COMEX, on the CME. I mean, a week worth of trading on paper is more than 1 year worth of supply. So how can you have so much trading and yet you don't have that price volatility, right? And then if you look at also the commitment of traders position, when you have these many contracts and sometimes you have a Friday sort of dump, but yet the change of the commercial contracts is only the tune of 10 to 20,000 contracts. None of it really makes any sense, Chris. But the bottom line is, go back to answering your question is that the tide continues to build up, and eventually the dam will break. And right now we're literally at that tipping point for gold, especially. So if gold were to continue over $2,000, I think they're going to lose the handle on the 2,000 level, of which is going to just go to 2,200 to 2,400. And that's not just my forecast. It's like the Pierre Lassonde, the legend, ex-CEO of Newmont. He also called the shot. So then I say $2,400 gold, and add say a bit more favorable gold to silver ratio of say 60, you'll be looking at $40 to $50 silver, and that's probably my call this year, Chris, because the gold to silver ratio went from 100, which is the top, and now it's at 80. Every time when you had a ratio went that high, which only happened 2 or 3 times in history, at 100, the pendulum is going to swing the other way, and when it swings, it can go as low as 30. Which means at a $2,400 gold at a 30 gold to silver ratio, you could potentially be looking at $80 silver. Nobody knows. I don't know. But what I do know is when silver takes out $28, and it's going to challenge 35 very quickly. And 35 is only a brief stop, and it's going to go past 35 to whatever uncharted territories that they yet to be seen.
Yeah, I've certainly heard a lot of people suggest as such, and something that you mentioned in there and heard in a couple of your other interviews recently, that you see the management of the gold and silver price breaking down. Is that primarily because gold is now over 2,000 and there's a lot more attention, and we've seen a consistent bid over the past year from central banks buying gold? Or what leads you to think that might be changing?
Well, fundamentals and technicals, sometimes they feed into each other, especially when you have a very strong fundamentals. Then the technical trends will have to follow. You're right. I think first of all, it's not to do the current fundamentals. It's not to do with inflation, Chris. It's not to do with CPI. I just find it a little bit amusing that when CPI was low, people would say the numbers are rigged, and the CPI is high, they're embracing like a Bible. It's the same people that are making up these numbers. So it's not so much CPI. It's not a bank failure. It's all about central bank diversification. Like I mentioned, $2 trillion of foreign reserve from the Saudis, from India, from China, from Russia, and these people are very concerned about getting their SWIFTs cut off. Chris, I also know, like some of my friends in China, they don't have access to U.S. dollar banking anymore because their last name just happened to not gel well on the blacklist. And so it's a very capricious, arbitrary SWIFT system that people are increasingly getting very agitated and concerned about, and they're diversifying away from that system. Um, and people say, you know what, they're going to go to renminbi or Chinese currency or euro, some other system. Well, you know what, they're just as capricious and arbitrary, right? So instead of the Fed lifting its lever, I mean, would you feel more comfortable having the Chinese communists in Beijing, that's governing your savings in renminbi? Doesn't make any sense. So I think number one is that foreign bank diversification, the reserve currency. But secondly, that's also then fueled and supported by the sentiment or the advent of central bank digital currency and all the different mandates. Some people just don't. Some people don't want to put up with it, Chris. I don't want to be dictated on where I spend my money, right, when I spend my money, and what I spend my money on. Like, for example, I'm just ready to go on a trip tomorrow morning to Vancouver from Asia, and they're tracking my carbon spent. It's 650 kilo of carbon. What does that mean? Well, Chris, there's talk about capping your per capita annual spending carbon at one time, which means that if you take a transatlantic or trans-Pacific trip, and you might be eating tofu for the rest of the year.
No steak when you get there.
This is not some hearsay. This is in the works. And guess what? You have to find out. So the way for people to get out of this mandate is owning gold and silver. And that's why I've been telling people since late last year, and even myself started buying gold and silver again. I bought a kilo of gold, for about $60,000 while I was in Taiwan because there's tax and I was cheap. In hindsight, I should have bought silver, but there's tax on silver. But you have to start getting back into the physicals. That is going to be. We can talk about what happened in the nickel futures market last year. They literally rolled back, Chris, a day worth of trades when nickel went from $30 to $50 a pound, and they literally settle everybody's trade at 30. They roll back the trades, and now the London Metals Exchange is facing a multi-billion-dollar lawsuit. So the paper market is kind of all fun and leverage, and see your numbers going and nuts. It's kind of cute, but eventually you got to go back to the physicals. And even though the premium for silver is highest it's ever seen, you're going to pay something like a $10, $15 premium for an ounce of American Eagle. That's going to go up more, Chris. And the reason is the power that be are deliberately throttling the supply to the mint. And that is a way to sort of prevent people from owning gold and silver. And eventually, that link between the paper market and physical market will break down. I know, it's almost seems like we're preaching to the choir, Chris. I've been at the market for 23 years, and I think we're at that sort of the final chapter. And for the powers to have to sort of go after this mandate of own nothing and be happy by 2030, they have to make sure everybody's on the bandwagon. And I think a lot of people are not going to get on this bandwagon of central bank digital currency. And the only way to circumvent that would be to be owning physical gold and silver.
Yeah, I hear you. I think people are concerned about it, and will be interesting to see what degree of buy-in there is to such a product like that. I think there's a lot of people that have no interest in going along with that, and will make it harder for the implementation. Going to pull up the nickel chart here because it's interesting what you mentioned there, and that's just about a year ago when we did see that happen. And like you pointed out, it was pretty incredible that you had people come in and just find out, all right, your trades for the last 2 days canceled. Pretty unprecedented. Are you surprised that things have basically kind of gone back to normal? I mean, I know there are those lawsuits, as you mentioned, out there, but that there hasn't been any further disruption in the nickel market? And do you see things as settled there, or is that something that perhaps maybe pops up again, whether in nickel or in another market?
Well, Chris, you saw that March 2022. This is measured price in per ton of nickel, not per pound. But the price actually went up to over 50,000. Actually went up to something about 80,000. So they were even showing that as a print because they rolled back the price. Things are not normal, Chris. For nickel, the nickel volume is only 1/10, about 10% of what they're trading before. And they instituted a lot of rules and like they put a lot of rules up. You cannot the margin for nickel right now, I think it's around 70%. So it used to be, like gold and silver, you can have a 5%, $5,000 can buy you an ounce of can buy you a silver contract uh that's worth $30,000, and you can buy 100 ounces of gold. That's almost $200,000. So the margin for nickel right now is at around 60 or 70%, which means you literally have to put up the entire cash position to buy a contract of nickel. And then they put a lot of restrictions on the ownership by retails. So there's a lot of different changes that there, and then there's a cap limit on up and downs, and then they cannot short, and all the different rules it's not a level playing field. And so the nickel price is a bit of much. It's come back all the way back to where it started before the big run up in 2022. I think part of that, Chris, is to do with just a bit of slack in the global economy, and that's why you're seeing, even though gold is over 2,000, copper is still below $4, and oil is right now at around $72. So what we have right now is a bit of a stagflation where the global growth is modulating, is cooling down, but yeah, there's inflation that's running quite high. So the market is not back to normal. It's just that they're putting a lid on the nickel price. For how long, I don't know. Personally, I'm a bit more bullish on gold and silver, given all these uncertainties like we talked about, all this money that's gonna have to seek refuge and safe haven. But the base metals and the energy prices, we have to sort of there's still a bit of a supply and demand issue. But I think over time, I would say the next 18 months to 24 months, you're not going to see people finance $1 billion, $2 billion mine, nickel mine, or silver mine, or copper mine. Doesn't matter what project, especially given the interest rate right now, LIBOR +5. You're looking at it just mathematically and then just logistics wise are almost impossible to build new mines. And Chris, I think a lot of the miners, and I was on another show talking about it. You don't have to worry about companies like Silver Elephant or First Majestic increasing production, because the nice thing about rising metal prices is the margins and the profit, the cash flow will be delivered through higher margins, not through more quantity. Whereas when the metal prices are trending the opposite direction, then the miners are more motivated to increase production to make up for the shrinking margin. So I think over the next 12 to 18 months, we're gonna see a lot of the supply started to be withdrawn from the market, simply because mining is a reserve depleted business, and you're not gonna see that being replaced or replenished by new discoveries or new production. But gold and silver is having a big sort of run ahead of base metals, because all this trillions of dollars sitting there looking for a home. But I do see base metal play catch up, probably not right away, but towards the later part of this year or next year. Correct.
Yeah, I hear what you're saying, and certainly on the supply side, we have Silver Institute reporting there was another large deficit 2022, and then add on now the new policies out of Mexico, which are going to make it a little bit harder to get permitting and projects launched there. Although, John, wanted to turn back to something we started to touch on earlier, which was silver relative to gold. Silver is certainly quite an interesting history, where obviously we had the spike to 50 back in 1980. We had that spike again in 2011. Although if you take those two out, interesting, we're actually at $25.50 silver. Aside from those two brief periods, this is really almost a high for the silver market, what we've seen over the last couple of years. And again,
Yes.
So there's a variety of ways to look at what happened in 1980 and in 2011. Is that the outlier, or is that where things should have been? A lot of trading that was involved in there, but how do you relate silver to gold in terms of, again, as we now have silver at an all-time high, we see, or at gold at an all-time high, silver half of its all-time high, but how do you look at that? Is it priced appropriately now if you remove these two trading events, or what would you say there in terms of putting that in context?
Yeah, Chris. I mean, silver is now in somewhat of an uncharted territory because it's staying at this elevated level already for for more than a year or two at this around $25 level, which is never tried out before. Um, and you just see a couple of spikes, and these are event driven. As you know, the Hunt brother in the 80s, and then the 2011, I think, was some Asian investor together, Eric Spratt, went to the market and try to corner with try to buy 50 million ounces of silver. So we're in a very acute market right now, Chris. I believe that if somebody would come up with say a couple $1 billion and want to buy 100 million ounces of silver physicals, that will break the market wide open. However, having said that, if you would actually do that instead of getting silver, having put up the money, you're going to get a call from the Fed asking you why you want to get that silver, right? So they're doing this quite stealth and try to sort of find different avenues to try to accumulate that silver. The gold to silver ratio last year was at 100. So I'm not thinking for the gold to silver ratio. That is at the extreme level. Usually when that pendulum swing on that extreme, it's going to swing back to the other extreme. And the other extreme would be, say, back in 2011 when you see gold at silver at almost 50, and gold was, I think, at around 1500. So that gold to silver ratio is at 30. So if it, like I said, if it revert back to a gold to silver ratio of 30 at the $2,400 gold, then you're looking at about $80 silver. Silver right now is very attractively priced fundamentally. And how do you sort of gauge what the fundamental of silver price should be? Well, you know what, Chris? If you take an ounce of silver eagle, that's about $35. That gets you sort of that probably is not still enough to get you a steak dinner, right? At Morton's or Chris Root. So that just tells me that silver is still a little bit underpriced, and there's really not a right level for silver price per se because it goes up and down so violent, just like the oil price. But these natural ratios, as you saw right now, silver gold ratio is about 80, so that's tend to be about high side. I would say that's a personal gut feeling having been in the silver market for more than 20 years. But the fair market value for silver coin right now should be at around $30 to $50, which is what they're trading right now because the $25 is artificial, as you know. You cannot get a physical ounce of silver for less than $30. So right now we don't have any fraud building into the market, and then when you notice there's fraud, you're gonna see that gold to silver ratio start trending down to the sub $50 level. I want to talk just really quickly on why those spikes. Chris, we mentioned about the price management. And last year I was paying a lot more close attention to the futures market. But this year, since October, 6 months ago, I took a hiatus from Twitter market and the interviews because I'm busy running Silver Elephant. Is that the cartels will, in fact, when they see a breakout of the silver interest, right? When there's a lot of silver interest, for one reason or another, they will let the technical guide them. So if a technical level is broken out, such as silver at $28, or back in 2011 and 1980, they will not only interfere, they will not only choose not to interfere with the market, they will actually even feel the market. So what I mean by that is, Chris, they will actually go into the market and buy futures contract. They will actually buy it and feel the market to try to establish the peak and try to exhaust the buying. Because remember, Chris, if somebody has $100, their buying power is half of when silver is at 50 versus 20. So what they want to do is have a lot of people buy at the top, try to feel the market, and then once the top is in, they will start chipping away. And that's why we endure 3 years of pain and suffering. Remember back in July of 2020 when silver went from 14 to 28. That's the exact replay. Nobody knew whether silver could take out 28 and gold could take out 2100. They made it a try. They made it a push. These levels were held, were defended. And then we went through this pain and suffering because all the buying was exhausted in that first try. And so they were able to sort of, keep a cap on it for the last 3 years. And now we have an $18 low 6 months ago. So that was a panic selling at bottom. And this time, given the bottom is a lot higher than it was before, which means that more and more likely with the water tide that's building up, you're going to see that $28 technical level being breached. And once that happens, then you're going to see a lot higher prices going forward. So, it's been a little winding answer to the question. I think it's some of that's technical driven, but fundamentals this time is even stronger than before with the foreign bank reserve diversification, and that you don't want to get too cute, Chris. A lot of people that can catch the bottom, but those are people not the ones that make the money. As I mentioned, once the $28 breakout, you're going to see the cartel even buying, right, to try to create the top. So you're going to see some very, very violent move on the upside, because what they want to do is to get as quickly to the top as possible. And from that point on, then they would do then they're going to come out of the woodworks and start dumping physicals, dumping futures, dumping ETFs, and all the different ways of which they can to manage the market. So you don't want to miss out that 6 months of gain, and that's going to be where the greatest has happened. And I think it will happen this year after silver takes out $28.
Yeah, and along with that, how do you factor in what we've seen in terms of some of the warehouse stockpiles on the LBMA and the COMEX? Does that concern you at all that we've seen them get pretty low, especially last year we had India importing a record amount of silver. So far this year, they've basically dropped off a cliff. But do you think that becomes an issue at some point?
I don't pay a lot of news on the day to day. I look at the big movements such as the alliance of Russia with China, with India, and what they're doing with their finances and their foreign reserve. So, a lot of this, and there's, and if you were to chart through time, Chris, and I studied, there is not actually a clear correlation or linkage between the inventory level and the price level. So I don't read too much into it. And besides all the inventory that's there, who knows, right? Maybe these are phantom inventory, even when there's inventory out there, because once the silver moved into a register category, then it's not silver to be had anyway. So I don't really read too much into it. I don't have any particular sort of intels into these inventory levels. But I will also say that if you look at a lot of the government published figures on gold and silver consumptions and imports, again, I will read that with a grain of salt. Nobody really knows what's happening. I mean, unemployment numbers, import-export numbers, all that, GDP growth, none of it is really sort of registering into my radar. Rather, instead, what you'd be looking at is the dollar, the movement of the dollar. I think that's going to have a short-term effect on gold and silver prices. And these technical level for gold and silver, which is $2,000 for gold and then $28 for silver. Silver is a little lagger right now. Part of it is because silver is industrial metal, and you're going through that industrial slacks. But over time, over the next few months, it's always the case that it's always the speculative demand that drives the market. I mean, if you look at oil, that's a perfect example. It went to negative. It went to 100, right? When it went to net minus 20, it doesn't mean that people will use oil anymore. Same for silver. It's always going to be that speculative demand that drives the market going forward.
Okay, and one thing that you mentioned in there, the dollar as well, which we've seen, and I'm going to pull up the chart of that, but obviously back at the lows of the silver market last year was when we had the dollar spiking up to 114.
Yep.
Has come back in quite a bit since then. Interesting when you think that the Fed is still hiking, how much it has come back in. And any thoughts on where we might be headed from here in the dollar chart?
I've been saying for the past 18 months, I see dollar trading on a band between 100 and 114. The reason is the dollar is a G7 currencies, and all the other currencies like the pound, the euro, the Japanese yen are all subordinated to the dollar. So I'm not a dollar bear per se. I'm dollar bear in terms of dollar measured in gold. But I'm a little bit surprised to see the dollar hasn't bounced yet, given sort of, it still has that different interest rate differential higher than the other G7 currencies. And maybe that speaks for the fundamental weakness of the dollar, and the dollar is losing a bit of its image. Um, but the euro is hitting a resistance at 110, the pound is hitting resistance at 125, and the Canadian dollar is weak because the oil prices are low. I would not be surprised to see a bounce of the dollar, especially in the summer months, or it could be engineered so that they try to put a lid on the gold and silver prices. However, Chris, on the interest rates, I am a firm believer that the rates are going to be headed a lot higher. This is just a temporary breather. And if the rates are head higher, that's going to be another supporting Russian, sort of another reason for the dollar to be headed higher, which means that we could be seeing a bit of correction in gold and silver, as they trade usually the opposite of the dollar on the short-term basis. This is not a high confidence call because we're in different times. You could see a scenario where the dollar sort of trading between 100 and 105, and where gold to break out of this dollar inverse trading band, and then for the next couple of months before interest rates start heading higher again. So that's maybe my highest that's probably the most probable event that I see the dollar not breaking down, but not breaking out either. But the gold could be breaking out past 2000 and sort of sever that link with the dollar index. It's not a high confidence call, but nonetheless, like I said, you don't want to play too cute and thinking and waiting for the dollar, anticipating a dollar rebound and be selling gold out too early, Chris.
Yeah, and what is it that you think is going to be driving rates higher throughout the rest of the year?
Driving what?
Rates higher. You mentioned you see the rates going up throughout the back half of the year.
Yeah, Chris, if you could pull up the 10-year chart since 1980, you're looking at a bear market for interest rates for more than 30 years. The race actually broke out in around 2018, 2017 under Trump, but Trump managed to put the lid back on the 10-year rates. So the 10-year rates went from 20% to 1.5% in the last 30 years. And now what you're seeing is a major breakout. Okay, that's back in 1981. You see there, 15, right? So if you draw a trend line, the race broke out at around 2018. But then somehow that was suppressed for an extra couple of years until 2021. Usually when you see such a breakout of a 30-year pattern, bear market, that usually the trend is going to go reverse and it's going to go opposite a lot higher. So I mean, ask every sort of a average chartist of what you see here, especially if you see it in a log scale. I would not surprised to see the 10-year headed at around 7% range. And given the rates went from like less than 1.5% to almost 4% for the 10-year in less than a year, I mean, it's already more than double. I mean, that was a major carnage in the bond market. So right now, the 3.5% is a very strong support level for interest rates. I think it's going to probably be hovering around this level for a few more months. But I would not entirely be surprised to see the rates go back to its upward trajectories, embarking on another bull market for continued rising rates this time next year or early next year, or even towards the later this year. And the reason being, Chris, is it's not to do with inflation or CPI. I mean, these are artificial instruments. If the Fed says higher rates, then the rates are go higher. That's simply it. And the reason they want to do that is to fit the 2030 agenda by the WEF of all nothing and be happy. So this is a deliberate attempt to wipe out the middle class. And I've been sort of pondering for a long time why you had these ridiculous, nonsensical quantitative easing for more than a decade. Well, the reason is this: they want to get everybody hooked on debt. So now they are now coming home to roost, right? By jacking up the interest rates and bankrupt you. This is by design, Chris. This is not to do with inflation or put the inflation back in the dragon. Unfortunately, I was born in the 70s, so I didn't really see what happened back in the 80s, exactly how it played out. But I mean, the script doesn't fit sort of what I see in terms of the action. I mean, Chris, oil is at $70. You know, last time I remember when Janet Yellen was lowering interest rate when oil was 120, and the script was, oh, you know, there's slacks and the inflation could be trading at a band, and we got to have a little bit of room for adjustments and whatnot. And oil's at 70, and they're raising interest rates. Back in the days, Chris, if you had a banking fallout like Silicon Valley Bank, it would have been emergency 50 basis point cut already in the cards, and yet they're still raising interest rates. And these are the same actors. So I think to be believing in the Fed is feeling its mandates as independent. I think by this point in time, you got to be a little bit too naive to really still buy into that thesis. And you know, you have these banks of this Calicari of governor from Minnesota or Michigan, right? I mean, he was the loosest dovish guy you ever seen. And now he's coming out and saying we got to nail it in the butt. I mean, this is the same guys. I mean, these are people who are being fed the script on what to say and to fit their agenda. So, and given that if you really see through what's really happening in the big picture, then you have to come to the same conclusion, which is the rates are going to go a lot higher. I would not be surprised to see a 10-year at around 7%, which means your mortgage rates will be around 10%. This is not a real easily traveled. You're still going to get pushback from the CalPERS, from the pension funds, and you know, so it's not a slam dunk per se. However, you know, this is the plan that they have, right? The power that be, and whether that gets executed or not, we have to wait and see. I would say they have the upper hand because they control the Fed, the Treasury, the executive, the legislative, and the just about everything that there is under the sun right now, globally.
Yeah, I hear what you're saying, and certainly it does seem like there's a lot of control out there. Geez, if we did get to a 7% rate, that seemingly would not be too pleasant on the current economic structure, and let alone as the real estate market, as you mentioned. So will be interesting to see how that plays out going forward. And John, appreciate everything that you shared here today. And perhaps before we wrap up, you could give us an update on how things are coming along at Silver Elephant, which is the company you run, and perhaps you could update us there.
Well, Chris, we survived the carnage. A few juniors, I think you probably track as well, didn't make it. So we come out of this doldrum in 2022 debt free. We maintain a good community relations in Bolivia, and Bolivia continued to attract good investments from Toronto and from New York. So, I mean, overall, Bolivia is still a reasonable place to do business, and we have a good local support. The project is well advanced with 100,000 meters drilling in the past. So, I mean, further adding ounces was never really sort of our highest mandate. I think what we are sort of thriving to do, which is to make sure that we keep the lights on, make sure we have good relations with the government, and waiting for that moment to excel with the silver price. So I mean, the elephant stock price is a low end. You know, it's quite a lower than it was 3 years ago. But as you know, Chris, these junior outfits, they trade, right? Sometimes they trade a lot higher relative to their value in the ground, and sometimes they trade a lot lower. And we're going to continue to plug away. We do have an exploration program that we're going to do. We raised about $1.5 million earlier this year, so we're okay funded. From that regard, we minimize that dilution, and right now I think we're trading at around 50 cents, which is from the high of over $2 a few months ago, and we're being hated by a lot of people. But yeah, you know, everybody else kind of pretty much the same boat. So we just kind of hunker down and cut our expenses, and I think that as silver prices continue its upward trajectories, I think it's going to have a very nice run before the end of the year. You should be seeing a lot of news coming out of Silver Elephant. I mean, we got 100 million ounces of silver in the ground, and trading at around 20 cents an ounce of silver in the ground at $20 million market cap. Usually at the peak of the market, Chris, like it was back in 2011 and 2021, you usually could be looking at around $1 an ounce of silver in the ground. So that is sort of the guide to valuing a silver company by looking at what the valuation assigned to it per ounce silver in the ground. So I think all in all, we're a bit of in a doghouse right now, but none is lost. The silver is still there. We're still good terms of community relations, and the people, our team, are will continue to add to our team, and so overall, That's fingers crossed. Hopefully, our silver forecast turns out to be right, and then some of our shareholders that managed to stick with us will see the light of day.
Yeah, well, I know you've been de-risking the project and you have a 12-hole drill program going on now. Any other catalysts just that people should be aware of going forward in the next couple of months that they want to keep their eyes out for?
Yeah, Chris. I would say we don't have any. I would say not even so much positive news. There's a lot of ounces in the ground, everybody knows, but rather we don't have any surprise in the closet, right? Like an issue with permitting or issue with community relations, as you know, Chris. A lot of companies in Mexico are experiencing problems, and so I think overall, Bolivia is a country where we're quite comfortable with. Now I'm doing just sort of getting re-engaged with the investment community, and not to forget about us. We're down, but we're not out, Chris.
Well, appreciate that, and know it's been a challenging couple of years in the mining sector, although good that you keep moving the project forward, which, yes, getting through the tough times in the market is perhaps what leads to the success. And John, if people have questions, would like to get more information, can you let them know the best way to reach you?
Yeah, Chris, I am back active on Twitter. I took a 6 month hiatus, but you can look up just Silver Elephant John Lee. I've been around for more than 20 years. This is more than I need to know about the silver market and the mining sector. And I've been pretty right about my call in the silver bottom in year 2000 in July, as you remember. I came on your show, and then I was calling the bottom for silver at $17 back in October. And I think my call this year is that silver is going to easily take out $28 handle, a minimum price target of $35. And gold is taking out 2,000. I was assigning a gold at $2,000 in year 2023, and that was in October when gold was 1650. People were laughing at me, Chris. And yeah, we're already looking at 2,000, before halfway of the year. So that shows fundamentally and technically the precious metal market is ready. And I would not be surprised to see gold at 2,400, but certainly minimum 2,200. 2,200. We could be seeing a bit of a slow summer with the sort of the dollar bouncing as we talked about. It's not a high confidence call, but nonetheless, the big run up should start around September if we see a bit of slow summer, Chris.
Well, we'll certainly be following along and watching each day here, and appreciate everything you shared there. Again, people
Well, you can see, Chris. Go back to my Twitter if you don't mind.
Sure.
You see that I pinned right October 12th when gold was 1650. I said that the big crime study 2023 will be the year for gold at 2000. We're already there. And like I said, we have to upgrade our target at minimum 2,200. And then silver easily taking out $28. This is a good time to get into silver. So I highly recommend, as I mentioned to your viewers, getting the physicals, because you don't want to have that scenario with a paper nickel. And it will happen, Chris. We don't know when, but you could see a silver market up $3 to $5 a day for consecutive days. And when people get into that panic mode, you're going to see a halt of the CME, just like the LME. And you don't want to be left empty-handed. You don't want to be exchanging your silver paper at $35 an ounce of a silver being forced, have the market halted, and then have the market floated at $80 a week later, which is what will happen, Chris. This is not some hearsay. The nickel guys already gave you a warning shot there.
Well, it's certainly an interesting environment that we've entered between the paper and the physical dynamics. So we'll be watching and following along. And again, if you'd like to find out more about Silver Elephant, you can go to silverelef.com. And John, I thank you again for joining me. It's good to catch up and talk some silver as always. And best of luck with all the project going forward. And we'll have to do this again soon.
Such a pleasure, Chris.